Agricultural credit. Agricultural credit plays an important role in improving agricultural production and productivity and mitigating distress of farmers. Growth of rural economy depends primarily on infusion of capital from time to time. Realize higher productivity in both crop and animal farming. As the time gestation between crop sowing and realization of income after production is quite long, farmers borrow from various sources to meet their needs, like initial investment on seeds, fertilizers, and other family expenses on grocery, consumer durables, health and education of family, marriages, religious ceremonies, etc. At the time of independence, moneylenders and traders exploited small and marginal farmers and landless laborers by lending to them on higher interest rates and by manipulating the accounts to keep them in a debt trap. A major change occurred after 1969 when India adopted social banking and multi-agency approach to adequately meet the needs of rural credit. Later, the National Bank for Agriculture and Rural Development, NABARD, was set up in 1982 as an apex body to coordinate the activities of all institutions involved in the rural financing system. The institutional structure of rural banking today consists of a set of multi-agency institutions, namely regional rural banks, cooperatives, commercial banks, microfinance institutions. Let's quickly discuss these components of rural banking. Regional rural banks. Regional rural banks, RRBs, were conceived as institutions that combined the local feel and familiarity of cooperatives with the business organization ability of commercial banks to provide regionally oriented institutions that could direct credit to the underprivileged sections of the rural population. Cooperative banks. The wide geographical coverage of cooperatives, especially in rural areas, was primarily established to save small borrowers hailing from rural areas from usurious interest rates charged by moneylenders. Since its inception, it has been playing an important role in the socio-economic development of the country by making available institutional credit at affordable cost, particularly to the agricultural sector. Commercial banks form the most important part of the Indian financial landscape in terms of their role in channeling credit to the commercial and farm sector and facilitating the process of financial inclusion. With the onset of economic reforms, the commercial banking sector, which has retained its predominantly public character, has undergone a number of changes in terms of size, efficiency of operation, and financial soundness. Best practices achieved by these banks act as a guiding light or intellectual base for improving and de-risking rural banking services. Microfinance institutions and role of self-help group. These institutions offer financial services, mainly microcredit, to micro-entrepreneurs and ultra-small businesses, which lack access to banking and related services due to lack of availability of assets that can be collateralized against loan and higher transaction costs. The two main mechanisms for the delivery of financial services to such clients are relationship-based banking for individual entrepreneurs and ultra-small businesses and group-based models where several entrepreneurs come together to apply for loans and other services as a group. In India, the success of agriculture credit can be attributed to group-based models, that is, self-help groups. Self-help groups, henceforth SHGs, have emerged to fill the gap in the formal credit system because the formal credit delivery mechanism has not only proven inadequate but has also not been fully integrated into the overall rural, social and community development. Since some kind of collateral or down payment is required, vast proportion of poor rural households were automatically out of the credit network. The SHGs promote thrift in small proportions by a minimum contribution from each member. From the pooled money, credit is given to the needy members to be repayable in small installments at reasonable interest rates. To reduce risk of credit defaults, rural banks and microfinance institutions have natural inclination to lend money to a group of people rather than a single individual. By March end 2003, more than 7 lakh SHGs had reportedly been credit-linked. Such credit provisions are generally referred to as microcredit programs. Government should not get complacent by success of SHG's credit model. Deepening of financial inclusion is still a big challenge and has to be an important component of policy intervention in future. The focal point of these policies should be towards increasing the access to the organized credit market for marginal farmers and rural entrepreneurs. It should build on the existing positive experience of self-help groups, Kisan credit cards, ongoing experiments with mobile banking and business correspondence, credit delivery model of standalone microfinancial institutions, MFI.